Hello everyone, welcome back to our channel. So in the previous videos we have discussed about the theory part relating to O-level business and accounting studies. From this video onwards we will be discussing the accounting parts related to the subject. So today I will be discussing your grade 10 lesson 4, Introduction to Accounting. Let's get started. Okay, in this lesson we will be discussing what is accounting, objectives and needs of accounting, business transactions, assets, liabilities, equity, income and expenses that arose through various business transactions. So first let's discuss about what is accounting. Simply, it is the process of providing information required by the interested parties of a business for their decision making. Like I explained in the previous chapters, there are different interested parties, or we call them as stakeholders to a business. They require several information from the business to make their decisions. So these are provided through accounting. So the financial information regarding a business are very important for the interested parties to make their decisions regarding the business, like whether to invest or whether to give loans, like that. So when this accounting mainly provide financial information, we call it as financial accounting. So this is the simpler definition of accounting. But in broader terms, we can say the method of recording the transaction of a business measurable in terms of money in account books, their classification, preparation of financial reports and the provision of information to parties who need them as accounting. So this is the broader definition of accounting. So it says that the method of recording transactions which are measurable in terms of money. So that is what we call as financial information. Measurable in terms of money. And how we can classify them. And the preparation of different financial reports. We will be discussing these later. And the provision of these information to the parties. So this is what we call accounting in broader terms. So just remember both of these definitions when you are studying. Now let's look at objectives and need of accounting. So first I'm going to discuss about the objectives of accounting. So as I have mentioned earlier, accounting is required to provide different useful information to the interested parties or the stakeholders of the business. So the different business activities are impacting to the decisions of these parties. The way they conduct the business impact to their stakeholders' decisions. So accordingly, the main aim or the main objective of accounting is the preparation of useful information for parties displaying a liking for business to take decisions. That means accounting's main objective is to provide information for the decision making. And also, based on these main objectives, there are several other objectives of accounting as well. The first one is to know whether the business has earned an adequate profit. We need to do the accounting to get to know whether the business has an adequate profit or whether it has a loss. The second one is to know whether the financial position of the business is sound, whether there is a good financial position for the business. The third one is to fulfill the legal requirements. Like it has mentioned, it is mandatory requirement by the law for several organizations to present their financial reports. So they need to fulfill their legal requirements. The final one is to minimize disadvantages arising through omission and commission of transactions and to organize financial activities. So we have to do accounting to check whether there are any omissions or we have missed anything in our transaction and to organize our financial activities. So these are the objectives of accounting apart from the main objective. Okay, now let's discuss about the need of accounting or the necessity of accounting. The first one is maintenance of limited resources of a business subject to control. So we need accounting to maintain and control the limited resources of a business. The second one is by noting down the transaction of a business, oversights and delays can be minimized. When you are methodically note down these transactions, you can minimize the delays and you can have a better oversight of the transactions. The third one is measurement of profit loss situation and the financial situation of the business. When you are counting the transactions, you can determine whether you have a profit or a loss and how your financial situation is at the moment. The fourth one is implementation of legal requirements like payment of income tax. So when you are paying the income tax, you need to have your accounting done to determine what is the amount. And finally, planning and maintenance of future business activities. So when you are planning and when you are deciding on the future business activities, you need to determine what is our business position now. For that, you need to do the accounting of your transactions. So these are the need or the necessity of accounting. I hope you all got a better understanding. So now let's look at business transactions. What is a business transaction? So when we consider a business, when they are carrying out their business activities, they have to exchange resources with different parties. Like for example, if we take when a business is purchasing goods for cash. Cash and goods are exchanged between the business and its supplier. So accordingly, a business transaction, we can identify it as an exchange of resources between a business and other parties. So similar to this, there are different types of transactions that are occurred in a business. So in these transactions, the transactions that are measurable in terms of money are the ones which are considered in accounting. For example, if we take the sale of goods for rupees 100,000. So we are paying 100,000 to get goods. So that is an exchange transaction and it is measurable in money. And the monthly salary payment of 50,000. Obtaining a bank loan of 300,000. Electricity payment of 5,000. So these type of transactions we are considering in accounting. And also we call them as the exchange of resources. We are paying something in exchange for a resource. But in addition to these type of resource exchanges occurred in a business, there are several other types of events which are occurred in a business which we consider for accounting as well. For example, if we take damage to the trade stocks, which is worth 10,000 rupees. A damage occurs to the stocks of an organization. It is worth 10,000. It is also measurable in money. So we are considering these type of transactions as well. Another example is a trade receivable that becomes a bad debt with rupees 3,000. Bad debt means we are not able to collect it from the respected party. So these type of events are also considered in the accounting process. So this is the simpler meaning of business transaction. These are the simplest explanation. I hope you understood. So most of the transactions which are occurred in a business are usually associated with the purchase and sale of goods and providing services. So these transactions are either made on cash or on credit basis. Cash basis means the value of the transaction is settled at the point of the transaction. When we are doing that, the moment of the transaction is occurring, the value is settled. We can either receive cash or we can either pay cash. Credit basis means the value of the transaction is settled later. That means like we are getting the goods today but we are paying on a later date. Like that. So these are the two methods of doing transactions. So now we are moving on to the most important part in this lesson. That is assets, liabilities, equity, income and expenses that arose through various business transactions. So first we are going to discuss about assets. An asset is a resource controlled by the business as a result of a past transaction and from which future economic benefits are expected to flow to the business. For example, we can take buildings, motor vehicles, stocks of goods, cash, machinery, etc. Suppose you are buying a machine, you are purchasing a machine for your business. So that is a past transaction. And the purpose of purchasing this machine is to manufacture goods and sell those goods. So through the sale of those goods, cash flows are coming to the business in future. That means it generates future economic benefits. Suppose any item that do not generate any future economic benefit, we cannot consider such item as an asset to the business. It should ideally generate future economic benefits. And also, it should be controllable by the business. That means the machine you are buying and the stocks which are generated from the machine can be controlled according to the discretion of the business. The business should be able to take decisions regarding this asset based on their discretion. Suppose you are conducting your business in a building which you have acquired for rent. So such building you cannot consider as an asset for your business because you cannot control it. You have acquired it through the rental basis. So accordingly, there are mainly three characteristics of an asset. The first one is arose as a result of a past transaction. And the second one is it should be controlled by the business. The third one is inflow of future economic benefits to the business. So based on these three characteristics, the definition of an asset is built up. And also, we can classify these assets in a business into two parts, current assets and non-current assets. Okay, so what are current assets? The assets that are expected to be used, sold or converted into cash within a short time period such as 12 months in the ordinary activities of a business. That means current assets are the assets which we should utilize or we should sell or convert it to cash within a short time period. That means within 12 months period during your ordinary business activities. For example, trade receivables that needs to be recovered within 12 months. That means if you are providing goods in a credit basis, we call them as trade receivables. So there are trade receivables which you have to cover within 12 months period. So that is a current asset of the business. So what are non-current assets? All the assets that cannot be considered as current assets are considered as non-current assets, such as land and buildings, machinery, furniture, equipment, motor vehicles, like that. That means which can be used for more than a 12-month period, a long time period. Those are non-current assets. So I hope you got a better understanding about assets. Now let's discuss about liabilities. What are liabilities? Payables of a business to external parties that had arose as a result of past transaction. For example, bank loans, trade creditors. That means you are obtaining a loan today, but you should pay it in the future. You should settle that loan in the future. So accordingly, there are three characteristics of liabilities. The first one is arose as a result of past transaction. And the second one is outflow of economic resources when settlement is made. That means you are taking a bank loan today. We consider it as a past transaction. And you should pay this bank loan, or you should settle it in a future date. So when you are settling, your economic resources are going out. There is an outflow of economic resources when you are settling the loan. And you have a current obligation. That is the third characteristic. You have a current obligation. You have the obligation today to settle or to pay this loan in the future. So those are the characteristics of liabilities. Similar to the assets, we can classify liabilities into two types: current liabilities and non-current liabilities. So what are current liabilities? The liabilities that should be settled within a short period of time, such as within 12 months. So current liabilities are the liabilities that we need to settle within a short time period, like within a 12-month period, such as trade creditors. Accrued electricity expense. Accrued means payable. And then we have non-current liabilities. Non-current liabilities means all the liabilities that cannot be considered as current. The liabilities which are not coming under current liabilities. Like, suppose we are taking a bank loan. There is a portion of this bank loan that we have to settle after 1 year. So such liabilities we call as non-current liabilities. So I hope you got a better understanding about liabilities. Now we are going to discuss about equity. The value of asset that belong to the owners of the business we simply call as equity. That means, suppose the business has liabilities. So in order to settle these liabilities, the part of assets have to be used. So after you settle the liabilities, the remaining part of the assets are belonging to the owners of the business. That means, for example, suppose you have a loan to be settled and you settle this loan with cash. So cash is an asset of the business. So if there is any remaining amount of cash in the business, we call it as belonging to the owners, the equity. So as I have mentioned here in the example, a person called A starts a business and he invests rupees 100,000 when starting this business. So this 100,000 we call it as the equity or the capital of that person. suppose the business has 300,000 worth assets and also they have 100,000 worth bank loan. So how do we calculate the equity? We can calculate the equity by subtracting the liabilities, the total liabilities from the total assets. That means we have to subtract 100,000 from 300,000. So the equity of the owners is 200,000 rupees. So this is what we call as equity. Okay, now let's look at income and expenses. So what is known as income? Earnings from the operational activities of the business. For example, sales, interest received, rent received. The different types of earnings we get through the business activities, we call them as income. And what are expenses? Resources that contribute to earning income in the operational activities of the business. So, expenses means, for example, we take salaries and wages. So, in order to earn income, we have to pay salaries and wages to our employees. So, they are the people who contribute to this earning of the income. And we have to have insurance, transport cost, costs of the goods we sell. So these type of things we consider as expenses. So this is the simple explanation of income and expenses. Okay, so the profit or the loss of a business is calculated based on the difference between the income and expenses of a business. So suppose there is a profit. This profit is belonging to the owners of the business. Therefore, if there is a profit, we are adding that profit to the equity because we said that equity is belonging to the owners. So is the profit. Therefore, we are adding profit to the equity. So that means we can add the income to the equity and we have to reduce the expenses from the equity. So from that we can understand that equity is increased through the income and it is decreased from the expenses. So as I said, when we are adding the income to the equity will increase. But equity is increased not only through this income, but also suppose the owners are bringing additional capital to the business. In that instance also, the equity is increasing. But that additional capital, we do not consider that additional capital as an income. So accordingly, we can say income as the increase in equity except due to the increase from the capital introduction by the owners. So income is an increase in the equity but not from the capital introduction by the owners. That is another definition for income. And suppose the expenses. As I said, as the income belongs to the owners, expenses should also be borne by the owners. So these expenses we deduct from the equity. So these expenses goes to reduce the equity. But the decrease of the equity is not only occurred from these expenses. Like for instance, suppose owners are taking goods or cash from the business for their private use. We call them as drawings from the business. So if they are using these business assets like goods or cash for their private use, it will also cause to decrease the equity. But that is not an expense of the business. Therefore, we can say that expenses as a reduction of equity except due to the drawings. So that is another definition for expenses. For example, the salaries and wages, insurance expenses, cost of goods sold, interest expenses, these are the expenses of the business, but not including the drawings of the owners. So as I have explained, the difference between income and expenses can be identified as either profit or loss. If it is profit, it is belonging to the owners, and so same applies to the losses. Owners has to bear it. So ultimately, you have to adjust this profit or loss to your equity. When you adjust this profit or loss to the equity, so what are the remaining accounting elements? Those are assets, liabilities and the equity. So the relationship between these assets, liabilities and equity can be shown in what we call as the accounting equation. So this accounting equation we will be discussing in our next video more broadly. Now I'm going to discuss about the influence of business transactions on assets, liabilities, income, expenses and equity. I'm going to be discussing this using two examples. Example 1. Suppose Amal opening up of a business on 31st March 2021 investing rupees 200,000. When he is starting a business by investing some money, it is giving the opportunity to arise an equity through his investment. For the commencement of the business, it is the capital. We call it as equity. So, along with that, we receive cash for the business. So, cash in the sense of business, we call it as asset. So, through this business transaction, equity and asset is arise. I hope you understood. And the second example, purchase on credit. Credit means we are paying on a later date. Goods worth 50,000 from Kamal Traders on 2nd of March 2021 for resale. The stock of goods purchased for same are assets to the business. So however, either by credit or cash, we have purchase goods. When we are purchasing goods, it becomes asset for the business. But the sum of 50,000, we purchase them on credit. So this 50,000 is payable to Kamal Traders. If something is payable on a later date, we call it as liabilities. So from this transaction, assets and liabilities are arise in the business. I hope you understood that as well. Okay, with that we have come to the end of lesson 4, Introduction to Accounting. So in this lesson we have discussed about what is accounting, the objectives of accounting, need or the necessity of accounting, business transactions, assets, liabilities, equity, income and expenses which are arising through various business transactions. So I hope you got a better understanding about all these areas through this video. So see you guys with our next video on your lesson 5.